And good afternoon, everyone. Another beautiful day in Houston. I am Randy Price. His name is Matt Price, and together we are the Price Group. Thank you for joining us today. Our topic is market update, a time for finesse. Probably not a more perfect word for the times that we are living in now. If you have questions as we go along, type them into the chat box and we'll try to answer them as we go. Our goal is 30 to 40 minutes. Make the best use of your time. And the thought process here was the soccer theme with the World Cup coming up later this month. So again, with all that, let's get started. Who are we? We are a family-owned and operated wealth management boutique team within Steward Partners. 45 plus years of experience. We do follow a fiduciary standard. And retirement is exactly what we do. So if you are before retirement, retired, or retiring soon, you come to the right place, and we'll try to make this, again, well worthwhile your time this afternoon.
So we have quite a few clients on the call, so this might be a review, but for non-clients, this could be educational. Randy is probably too humble, so I'll brag on his behalf. He's received a number of accolades from Barron's, Forbes, Financial Times. Randy and I both were certified financial planners, along with having a third CFP, Matty Kearns, on our team as well. And then Randy and I both went to Wharton to get our CIMA, Certified Investment Management Analyst designation. And if you've been with us for any length of time, you're probably familiar with our Wealth Coach podcast. And we work really hard to produce some written literature to keep clients abreast of what's going on in the markets. So just a review for those clients. Our firm, Steward Partners, based off the biblical definition of stewardship. Our custodian, Raymond James. Custodian, just a fancy word for where client assets are held. We'll be introducing a few new custodial options to clients here in the next few months. That probably is not anything worth doing for clients outside of that they have more options if they ever were interested. But Raymond James has been a great partner, and we are excited to continue to work with them.
Is there ever a title that makes more sense than that? There have been a lot of shots taken on the U.S. economy, body blows, shots. How long can the U.S. economy defend against the recession? Well, you can look there at the Fed funds rate. That's the rate that the Federal Reserve sets as the short-term interest rate, the deficit, the average price of gasoline. Everyone's well aware of that. Inflation hitting records, manufacturing statistic, how many jobs have been created per month, the consumer sentiment, which is really interesting. We'll talk a little bit about that as we go forward. And then as we look at the S&P 500, the 500 largest stocks, not been many record highs so far this year in 2022. You might say it this way: the Fed wins with a golden boot. They've won that by having the most aggressive strategy, most aggressive central bank. Compare there the Fed to the Bank of Australia, the Bank of England, so on and so forth. The last 21 teams, winner of the Golden Boot, played for won the actual World Cup. So that's a famous trophy. Again, trying a little bit of a play on words on the soccer theme today. But the Fed raising interest rates, which is probably the thing they do, or most famous for doing. They have done so at the quickest pace in 40 years. That's a long time. So look at that 2022 cycle. A lot of 0.75 increases, and you've got some other times they've raised rates there as well. Has the Fed policy become restrictive? They've been aggressive in lifting interest rates to curb inflation. They've made it very clear. Those of you that joined us, we had a former vice chairman of the Fed. They talked about they did understand, or he thought the Fed did really understand that they had to get this inflation genie under control, maybe not back in the bottle quickly, but they've aggressively hiked interest rates to do so. And you'll see there in the pink part of the graph, starting from the first of the year through the middle of the year to the end of the year, we're in the restrictive territory. You've got restrictive, you've got neutral, you've got accommodative, and the Fed wanted to get out of the accommodative, but they would have preferred to be in the neutral. And then you can see there on the right-hand side, tightening financial conditions. First Fed rate hike. And again, different years have different colors, but for 2022, it's the dark black line. And there we are, folks, right in the middle of a Fed tightening cycle.
So we call this an own goal recession, the potential for a Fed-induced recession. You probably have seen on TV, possibly read about soft landing versus hard landing, what that means. Soft landing means that the Federal Reserve can increase the interest rates without pushing the economy of the US into a recession. And we think it's all contingent upon how far does the Federal Reserve go. So we've illustrated a few potential outcomes. Randy mentioned here just earlier, the current Fed funds rate, or the short-term interest rates, call it 3.25%. And it's expected with certainty that the next time that the Federal Reserve does get together, they will increase another 75 basis points. That's at least the expectation. So that puts us close to 4%. What we think is already priced into the market is a mild recession for sometime next year, 2023. But if the more that the Federal Reserve would increase short-term interest rates, we think the more severe that the recession could possibly be. As of right now, though, it looks like the kind of most used numbers are the Federal Reserve might tighten at least once, maybe twice more, and then start to move sideways. Hopefully, if some of the inflation numbers are under control. But we think it's possible, not probable, that we have a quote unquote soft landing where you do this without a recession. Our best guess, and what we think the market has priced in, is a mild recession for sometime next year. So why do we expect a muted recession? Randy and I, we say a lot, humans are linear thinkers. What we mean by that is if it's rained recently, we think it's going to rain in perpetuity. So we think of the last recession, 2020, which was a severe recession. We think of the previous one before that, 2008, 2009, being kind of, that is what a quote unquote recession is. But those would be by definition two severe recessions. The reason we think it could be more muted, no pandemic. From best we can tell, there's no housing bubble. The banking system is healthy. And when we look back to the late 90s, which a lot of clients do remember, the technology sector was way overpriced within the market. And we don't see that now, of the tech sector being near exuberance would be a word that is used a lot. Couple that with the fact that the average consumer still has a lot of cash on their balance sheet, and also a lot of companies still are flush with cash. So we don't see it being what we would call a systemic issue, something that would affect all companies, all people. And we think it would be a more tame recession than the last two we've experienced. And here's a little more of what we would just project. Draw your attention to this bar chart on the right, the worst being the Great Depression back in the late 20s. And then just 4 notches up would be COVID, 2020 induced recession. And so this is just our projection for 2023 here in the goldish box of what a mild recession would look like. So don't think that's necessarily too optimistic. At the same time, I don't think it's overly pessimistic. I think it's a pretty middle of the road, at least as of today, what our best guess is of what the next 12 to 18 months would bring.
Again, continuing on our soccer theme for the day, where has the defense been? There have been a few places to hide during 2022. We've been in an extended bond bull market where bonds did very well. And so far 2022, we've been in a bond bear market where interest rates have gone up, bond prices have come down, and the bonds have not offered the ballast that they historically have. There we have a 60% equity, a 40% bond portfolio, having historic drawdowns. Again, given that both pieces of the portfolio, if you will, we're having bad years. And then on the right-hand side, the culprit, high inflation, uncertainty has made some changes there. And again, we've seen the 10-year Treasury move from about 2% to currently the 10-year is about 4.25%. So a huge move statistically as well as mathematically over time. And it's been tough to play defense there. Again, interest rates up, bond prices down. 10-year Treasury yields highest since 2010, largest one-year increase since 1994. And the negative yielding debt around the planet has indeed vanished. So here we go.
And a few potential being keyword there, game changers to reverse the interest rate surge. We're on record from earlier this year saying, hey, sometime in the fall timeframe, we think that inflation starts to roll over. And that wasn't Randy or myself just holding our finger up and feeling which way the wind goes. But when you look back at history, monetary policy, or when the Federal Reserve is making decisions that affect the economy, it takes anywhere from 9 to 18 months, call it, for those policies to kick in. And late last year, the Federal Reserve started to say inflation is something we should pay attention to and started to put policies in place to combat that. And so coming up on that 9 to 12 month period this fall of having monetary policy work through the system to slow inflation down. You've started to see inflation kind of level off, but not moving lower at the pace people would want or expect. And that continues to be the main headwind. I'm sure most everyone would agree for the stock market of we just don't know exactly when inflation will get under control. But looking here at this slide, yields typically do decline. So interest rates typically do go down during a recession. And yields also go down when inflation slows. So that would be our base case scenario. Obviously, historically speaking, different things have happened when inflation does turn over, but we would say that would be our base case or best thought moving forward. And then the box right there on the right, the 10-year yields peak after the last rate hike. This is a look just historically. When the Federal Reserve does stop increasing interest rates, rates typically do fall, as you can see. So resetting the bond game plan, some of the bond experts at Raymond James, they have a 3% 2023 end of year target for the 10-year US government bond. So Randy mentioned earlier, currently that 10-year US government bond is a little bit above 4%. So that would be rates moving lower over the next, call it 15 months. And if that's the case, that would be a little bit wind at the back for some of the bond prices until then.
So what's happening in 20 days is the midterm elections, toss up for the composition of Congress. Following the midterms, there likely will be a split Congress, according to some of the people that were following this on there. So you can see there the various graph down at the bottom between June, July, August, September 22nd on R for red, Republican House and Senate. So anyway, what does that say? It means that nobody knows, but the economy remains the largest, the biggest issue for voters. And if people vote with their pocketbooks, it will indeed be interesting. The House is, I would say, very likely to flip, switch to Republican, 78%. And I think some of those numbers have continued to move higher over the last 20 midterm elections, though. 18 out of the 20 of the incumbent party has lost seats. So again, you can look at some of the numbers. Their sitting president's party, provable rating, retirements, toss-up seats, and narrow margins all enter into that math to get you to where the prediction is being made. So potential outcomes. What are the likely outcomes should the Republicans win at least one branch of the midterm elections? Well, the good news is the markets typically like gridlock. No major policy shifts, no change in tax policy, and again, increased scrutiny of large technology platforms, increased pressure on China and Russia. So again, nobody knows exactly what will happen. But historically thinking and looking at this from just the sort of common sense, these are some of the bottom line foundational thoughts for the upcoming midterm.
So we call this an injured start to the year, and we touched on this a little bit already. But the S&P 500, which a lot of people will say is the overall stock market, is off to its fourth worst start on record, which is a real, in my humble opinion, eye-popping statistic. And then with that being said, only 15% of the S&P 5 companies are in positive territory so far this year, and a majority of those that are positive are energy-related oil and gas companies. So to continue to play with that theme, we think a mild, moderate recession has been priced in. We think that the market is already expecting weaker earnings. This is something we pay close attention to every quarter, but you're hearing a lot more people talk about it, pay attention more closely with more scrutiny on, are the earnings of these companies going to roll over? Are earnings going to come in way less than people are expecting? And so far in this quarter, earnings actually have come in at or above expectation for a majority of the companies, which means that earnings are not moving as low as some had thought, which we think is a good thing. And then higher interest rates weighing on valuations. It's kind of, you haven't had really a good alternative to the stock market for a number of years, but with short-term interest rates moving higher, there are some other investment options out there, which is competing for interest with the stock market. But something that we talk about a lot, we think fundamentals are the real driver over a long period of time for companies to have a stock price that can move higher. And we briefly mentioned this. A bunch of the companies that we own have near record cash on their balance sheets. Sales are continuing to grow. Share buybacks, which can be a real important factor for the stock price, and companies continue to be very, very profitable. Randy and I, we also pay a lot of attention. The chart there on the right, dividends continue to move higher. Our dividend growth strategy, which many clients are familiar with, we're looking for companies that not only pay dividends, but we think have the propensity to increase their dividends year over year. So seeing forecast of dividends moving higher is music to our ears, and something that we're always monitoring behind the scenes.
We titled this slide "Hat Trick of Catalysts," 3 catalysts that could push the markets higher. Number one, better than expected earnings season. Matt, you talked a little bit about that. Most companies have done a lot of their financing, and so higher interest rates doesn't affect them as much. Energy prices probably are some companies. Then inflation rolling over. We mentioned that also could lead to less aggressive tightening cycle. Everybody's looking to see how far does the Federal Reserve have to go to get things under control. And then the third soccer ball there is midterm election timing. Again, those are 3 catalysts that we think could push the market higher. Sentiment is at one of its low points, and lots of times when that happens, things could move higher. But the fourth factor that could support equity markets is just that, investor sentiment. It's depressed, and if you look at that from a standpoint, some people are calling for the S&P to reach a target of 4,400 by the end of 23. Like Sir John Templeton's quote, "Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So we're a long way from euphoria on there. And then the chart on the right, the percentage you expect stock prices to decrease over the next 12 months. You can see that's quite a number of people, but the average person who would vote like that many times is a poor predictor of the equity markets moving higher. Time for power, a time for finesse. Again, sort of a takeoff on our title of the webinar today. It's not always a straight line up for investors. It's not unusual for the market at different times to go through periods of flat performance. So you got rising periods here in this graph, 27% stagnant, 73% of time. And so again, people like to see the market moving higher. Who doesn't? But there are many points of time, and it's very normal for the market just to sit there and look at you and go, why are you invested? This is not going anywhere. You could do better with your money elsewhere. And again, periods of growth are in green, periods of stagnation there are in that beige color.
So those were all the market updates we had. What we wanted to do is just spend a few minutes reviewing for clients our Live Well plan and really the process behind how we make investment decisions for the client families that we serve. But it starts with a baseline of creating a Live Well plan. And we joke and say this is the roadmap, the financial roadmap for the rest of your life. We call it a Live Well plan because Randy and I were kind of cheesy and couldn't come up with a better name, but we really do want our clients to live well leading up to and also during retirement. I love this quote from Benjamin Graham, who's one of Mr. Buffett's mentors. The best way to measure your investing success is not whether you've beaten the market, but whether you put in place a financial plan and a behavioral discipline that are likely to get you to where you want to go. And our Live Well plan is just that for clients. We want this to be the behavioral discipline, but also the financial plan to help you get through tumultuous investing seasons like we've experienced so far in 2022. And then a big component of that plan is developing a family index number. We're looking for the rate of return that you need to be quote unquote successful. And we define success as meeting your goals and having enough money throughout your entire retirement. And so some years we probably will outperform that. Other years we will underperform that. But we want this to be our average rate of return over a market cycle. So call it a 10 to a 15-year period. And when we talk about investment returns in that context, it's a lot easier typically to understand, okay, well, over time, I've kind of beaten the average I've expected, opposed to just looking at one calendar year that is negative. So the Live Well plan, we take into account market drawdowns. And that's a big part of the Monte Carlo simulation where we actually show you going through retirement 1,000 different times.
So lots of times we get the question, why do I need an investment process? Well, if you look back on the investments in your 401k or the investments in your portfolio now, hopefully you have a reason, some logic, a process on how you made those decisions. It's a very humbling experience to invest money, and you're not always going to be right, but you want to make sure that you're taking risk, return, and the probability of success into the calculation when you make that. How do you invest your portfolio to meet your needs during retirement? Well, you got to know what your needs are, and then what we find is many people make poor financial decisions when they're stressed. Actually, the scientists go back and tell us that. Matt, go back one more, please, there, if you would. On that, they let their emotions get in the way, and many times they make the wrong decision there. We are big believers in discipline. We are big believers in income generation. Hence, the several strategies of dividend stocks that we have in our portfolio. Those indeed are our core principles, and our bottom line goal is to preserve the assets while generating the level of income and then secondarily growth that you would need as a family to meet your objectives with confidence. We talk about comfort, clarity, and confidence throughout retirement. Investing without a process. This is a slide which shows that the average investor during these two periods in time, when actually the stocks went on sale, people were selling stocks, and the old adage, buy low, sell high. That's how you get ahead, is obviously buy when they go on sale, buying the dips, if you will. But in this case, going back, and the one on the right, probably the most recent famous, 2008, it was like going to Walmart or Costco or wherever you shop, and toilet paper, toothpaste, ink for the printer or whatever that you needed was marked down 10, 20, 30, 40%. What would you normally do? You'd say, well, let's go ahead and stock up. And but during 2008, again, the market, the downturn was so frightful. This could be, the end of the country, et cetera. People were scared, and they indiscriminately sold stocks. They indiscriminately sold bonds at a time which would have been very fortuitous for them to be buying stocks. Anyway, it was the best of times, the worst of times, depending on whether you had cash to invest. But we think if you have a process, you're going to do things with more logic. You're going to do things with less stress. You're going to enjoy the ride more, and your returns historically are going to be much better than the average investor, because you've had a process to make buy and sell decisions and to allocate your assets, and not just let your emotions get in the way. How you feel determine what will make up your portfolio.
To add to that, we think dividend income is going to be more important than it has been historically. But first, let's take a look at historically how important dividend income has been. From 1930 through the end of last year, dividends accounted for 40% of the total return of the stock market. So that's not a rounding error. That's a real material number. And one can make a fairly compelling argument that the next 10 years in the stock market are going to be not as rosy as the last 10 have been. From a standpoint, there probably will be more muted returns if you believe that there'll be a reversion to the mean. And if that's the case, dividends will play even a larger role as a percentage of your total return for the stock piece of your portfolio. So Randy likes to say that we were country before country was cool as it pertains to liking dividend paying stocks. And you're starting to hear a lot more people talk about dividend paying stocks as a income generating tool, but we have been doing this for years and continue to believe this is a great way to produce income, also hedge against inflation moving forward if returns are more muted. So most everyone on this call has created a live well plan. We could say want to create a live well plan or want to update your live well plan. We're updating live well plans and talking to clients about this on a daily basis. And our goal, the 3 C's, comfort, clarity, and confidence, is we don't think that is found by just looking at your monthly statement and looking at the bottom line. We think comfort, clarity, and confidence are found by understanding your live well plan, understanding what your portfolio is generating in income, and has this downturn really affected your long-term goals? And for most of the plans we reviewed here over the past few months, the answer has been no. But if you have the itch and want to answer that question personally for yourself, let's get together and look at the live well plan and review some of the inputs that we have figured for that.
So we talk about comfort, clarity, and confidence, and be happy to do so with you. Thank you for your time this afternoon. Matt, questions from our participants?
No questions, no emails yet. But if you have any, please shoot us an email, give us a call, and we'd be happy to answer anything that you throw at us.
That's Maddie, that's Tiffany, that's me, that's Matt, that's Melissa. We are the Price Group. Email addresses, phone numbers, and again, thank you for your time. Have a great afternoon, and hope to talk to you real soon. Take care.